Hello, Edyard Denny here. Well, can you believe it? It's 2022. I hope you had a great holiday season. I hope you had a great New Year's celebration. I hope you had a lot of rest and that you stayed healthy. My family, we've had some family and friends, more and more of them reporting that they've got COVID. It seems to be the very mild version of the latest variant. And it seems like everybody's getting this one. So hopefully, if it does strike any of your family or friends, it'll be mild, and you'll be good to go from then on, and will be impervious to any further variants of this virus. At least let's hope so. Let's get started. There's a lot to talk about. So I'm going to share my screen here. Go there. You already saw that. So it's a good year for us forecasting the market. Though I have to say that since March of 23rd, I feel like a bull that's been too slow relative to the market. The stock market bulls just keep stomping on my back, and I got hoof marks back there. We started out, Joe and I started out last year predicting that the S&P 500 would get to 4,300. We got there way ahead of schedule. We got there, I think, at the beginning of July of last year. So we upped the ante and raised it to 4,800. And we got smack dab there last week, Wednesday, on an intraday basis, closed a little bit below that. But that worked out pretty well. Let's see how this year works out for us. It could be the same thing where the market will outrun us. I'm not convinced it'll do that, but we're using 5,200, which is a fairly conservative outlook. In assuming that the market will go up as much as earnings, which can go about 8%. But where we're sticking our necks out is arguing that the valuation multiple is going to stay elevated around 2022 because of all of the liquidity that's in the system. So we'll be monitoring the situation obviously closely as the year progresses. What's there to worry about this year? Well, same old, same old. Pandemic isn't over. There's inflation, and then there's the Fed. There's always geopolitics, but let's focus on the pandemic, the Fed, and inflation. And here you can see the case count has increased dramatically. I think we're learning that the case count really doesn't mean much anymore because this thing is spreading. The symptoms are mild. What really matters is hospitalizations and deaths. And it's too soon to declare that this isn't the bad one. We've had 1, 2, 3, and this is kind of the fourth wave of the pandemic. We do have vaccines, we do have drugs, we have therapeutics. And so maybe we'll learn to live with it. I think we have been learning to live with it. And the market certainly seems to believe that that's the case. We know that something like 20% of pilots aren't flying right now because of the latest, they've been hit with COVID. I suppose the market should maybe be concerned that to the extent that this variant causes more and more people to have to stay home sick, that might be a problem for the economy. But I think that the perception is that the market is taking is the more optimistic one on this variant, that it's spreading like wildfire and it'll probably burn itself out, and the symptoms are much less severe, and we'll learn to live with it. The Fed, well, the Fed is widely expected. No surprises here. If the Fed raises the Fed funds rate 3 times, that will not be a surprise. The 2-year and the federal funds rate, as you can see, were both federal funds futures were both right around the federal funds rate earlier this last year. And then around the middle of the year, as the market started to sense that the tapering was coming, and then after tapering, rate increases would occur, the market started to show that at least one rate increase for a while there. And then when it was clear that inflation is not transitory, it's persistent, it became obvious that the Fed would have to move faster. And that's exactly what's happened. Early November, the Fed announced tapering, and December, they announced faster tapering that'll end by March, setting the stage for raising interest rates after that. And so the market's fully anticipating 3 rate hikes. I think that's reasonable. I think it's also possible that there might not be the third one. The Fed might decide rather than continue to push its luck, that they'll actually raise the inflation target. There could be some debate there. The Fed is likely to be more progressive this year in its composition. So that's something that I've been thinking about. The bond market has frustrated us last year for a while there. Like everybody else, we started last year thinking the bond yield was likely to continue to move higher. Remember how it had moved up from 0.5% all the way up to 1.7% early last year. And so it looked like we were on the way to 2%, and then it just kind of all fizzled away. Maybe there was the Delta variant, maybe with some other factors that we will be discussing in Tuesday's morning briefing, like demography. But what we are seeing is that the bond yield has been remarkably quiet, stable, with some volatility, but around 1.5%. It hasn't gotten to that 2% level. Well, we're going to try it again and argue that we could get to 2% this year. Not exactly the end of the world. I think it's be consistent with what the Fed is likely to do, and maybe inflation being a little bit more persistent than we were thinking or others have been thinking. But the conundrum may continue, and if it does, it'll be because of the aging demography in the U.S., comparable to what's happened in Japan and Germany, where rapidly aging demographic factors have created lots of demand for bonds by older folks, and bond yields over there are fluctuating around zero. But again, the conundrum is inflation has been going up, and the bond market, it's like on another planet, it's totally ignored it. And the question is, will it become more relevant this year to the bond market? And the answer should be somewhat more relevant. But we do think that, that we're getting pretty close to a peak in the inflation rate, and that might help to keep the bond yield from going much higher than 2%. Meanwhile, the yield curve, what's the message there? Well, as the 2-year yield has been going up, the 10-year has been fairly flat. We've seen that the spread between the 10-year and the 2-year has narrowed. And that's usually an indication that the bond investors believe that if the Fed's is raising interest rates, that could cause some problems in the economy or in the financial markets, and bonds are okay to buy. I've never seen this happen before the Fed actually started raising interest rates. So that's something quite unusual. But then again, we live in unusual times. But it is something to consider that the yield curve is predicting that 3 rate hikes might be enough. Meanwhile, back to the stock market, we had this huge PE rally from 2.9 to 23 in 2020. Then the remarkable thing is that the PE stayed in the 2022 range. We've been taking the position that it might do that, and that was a fairly contrary position, given that inflation and interest rates, inflation has been going up and interest rates might follow shortly. But the PE stayed here in the 2022 range. This is our Blue Angels analysis. And you can see that it's been a PE, it's been an E-led bull market really since the middle of 2021. And this is amazing. Look at this forward earnings trajectory, just continue to move higher and higher in a very much of a V-shaped formation still. So we haven't really seen this U-shape. It's been much more V-shaped, and we have yet to kind of catch up with this trend at some point. You would imagine we might. So again, back to that valuation issue. Notice that the valuation here has been sticky around 2022. The valuation of S&P 500 values actually come down somewhat, though it just jumped recently. Whereas the growth has been remarkably stable around here at 28, and it might remain that surprisingly stable in the face of high inflation and rising interest rates. Why? Because of liquidity, which I'll show you in a minute. Meanwhile, on the inflation front, the regional unfilled orders or delivery times, that average for the 5 Federal Reserve districts has rose to an all-time record high a few months ago. Now it looks like it's peaked and it's coming down, which I think is a sign that the supply chain disruptions may be starting to ease. The other way to get it is a slower demand for goods, leading to some moderation that allows for the supply to catch up. But as you can see, we are seeing some signs of that. To me, that one of the most interesting stats that came out while we were vacationing or just resting the past 2 weeks. Hopefully you weren't spending the past 2 weeks recuperating from anything. But the Japanese auto production came out along with industrial production. And this is fascinating. It took a huge drop here, very comparable to what happened during the lockdowns and previous kind of drops in, I think this was the meltdown of the nuclear reactor. But we had a meltdown here in auto production because they couldn't get the parts. And now it just jumped right back up in November, suggesting that maybe they are getting the missing parts. If that's the case, if Japanese automakers are finding the parts, then US, German, British, Brazilian, other automakers are going to get the parts. And that should be a source of economic strength looking at this year, because there is a lot of pent-up demand for autos. A lot of pent-up demand for other goods has been satisfied. So if that slows down, that'll give companies an opportunity to rebuild their inventories, which will be a positive for growth. So growth is looking actually pretty good this year. Consumer confidence looks okay. It ended up last year a little bit on the upside with expectations doing well, present situation, not doing much of anything other than staying relatively high by historical standards. So consumers are feeling pretty good. Their spending during the holiday season was very strong. Of course, making them optimistic is the labor market. Initial unemployment claims continue to hover around 200,000, which historically is very low, very tight labor market. The jobs plentiful survey also remains extremely high at around 55%. So the labor market is great. The purchasing managers index for the market data remains relatively elevated. So again, the economy looks good. This is fascinating, I think. This shows that despite all the problems that are out there with labor costs going up, labor shortages, supply side disruptions, commodity costs going up, look at the confidence measure here, the blue line for the CEO's outlook. It's an all-time record high. Very good, almost leading indicator for both the current dollar and real capital spending. So this is very encouraging. It seems to me that what it suggests is that overall CEOs say the business is great. The problem is getting workers and all the costs that they're facing. And they see as capital spending, particularly on technology, as a way to increase productivity and to make this all work out in a way that's a win-win for everybody. So that's a pretty upbeat outlook. Meanwhile, the liquidity, I said, there's lots of it. I'm not particularly concerned about falling off a fiscal or monetary cliff. You can see that M2 all-time record high data came out recently for November. You can see that all commercial banks' weekly data, they stopped publishing the weekly data for M2. So there's a proxy for that. We take the commercial bank deposits, and that continues to move higher. And then this is, again, the total demand deposits, not all deposits, but just demand deposits. And they've been kind of accounting for much of the increase in M2. So look at this chart. This shows that the liquidity as measured by M2 has never been more liquid. You can see the demand deposits as a percent of M2. It's not never more. It's about as liquid as it's been back in the 1970s. So tremendous liquidity of liquidity, lots of demand deposits that could go for financing economic growth, and of course for driving financial asset prices higher, as well as pushing inflation higher. All this is because the fiscal authorities pumped in lots amount of liquidity through checks and other stimulus programs. So we have accumulated large deficits. And of course, the Fed offset some of that by buying the treasuries and mortgage-backed securities and to the tune of trillions of dollars. So inflation, we've been thinking range-bound 4 to 5%, but they just won't listen. The headline inflation rate is 5.7. The core is 4.7. That's still in our range. We think that we'll go, I'm not changing the range yet, though I may have to, but right now we're leaving it at 4 to 5, and then 3 to 4. We think that with supply chain disruptions easing, productivity getting stronger, we think we'll settle down to 3 to 4. And we won't be surprised if the Fed announces that 3% is their new inflation target rather than 2%. So productivity is the big story for us. The roaring 2020s should be driven by productivity growth continuing to accelerate to 4%, exact opposite of what it did in the 70s when productivity collapsed. Labor shortages already causing businesses to realize they have to spend on equipment and technologies to increase productivity. Again, let's take another slice and dice of the inflation story. This is the consumption deflator, which came out again in the midst of the holiday season. We looked at it in this chart right there, the consumption deflator 5.747 on a core basis. Let's look at its big components: durable goods, non-durables, and services. And you can see that the durables was 9.7%, the highest since the great inflation of the 1970s. So that's something to worry about. But on the other hand, it's a sector of pricing that's has a history since the mid 1990s of being very deflationary and not being much of an inflation problem before that. So we're thinking that once the supply chain disruptions ease and pent-up demand gets satisfied, we could very well see the durable goods inflation rates start to come back, making a big contribution to making inflation less persistent. Non-durable goods, who knows? It's food and energy. It's not as bad as it was in the 70s. I don't expect two energy crises the way we had back then. I suspect the price of oil is going to stay around 70, 80. As we'll see in a minute, oil field production is picking up in the US. So we think the next thing that'll happen is this thing will moderate somewhat. Services is the area where we see problems, particularly in rent inflation. The service inflation rate is only 4.3%, but it's not 2%. It's not 3%, it's 4.3%. And it's certainly not anything like it was in the 70s, but rent inflation, because of what home price inflation has been doing, could really continue to be a problem here. Here's what I promised you on crude oil field production. It's took a dive. It's been kind of flat here, and now it's picking up. So that's an encouraging development in terms of thinking of why oil prices might not have to go much higher. Back to the durable goods story. A lot of it is problems with getting cars. The new car prices are up 10.8%. Used car prices are up 54%. And again, that's got to believe that those are coming down hard in this year. Medical care services, I mentioned rent is probably forecastable this year that it's going to go higher. It's harder to predict what medical care inflation is going to do in the PCED. It has been recently outrunning the CPI measure. CPI measure is out of pocket, PCED is out of pocket, and what insurance and government pays. So I don't know quite why this is reversed here, because historically it's always been lower. And if that's the case again, then maybe you'll see some pickup in the CPI medical care services, some moderation in the PCED. Here's the rent story. Again, we didn't even get close to zero inflation in rent as we had back here. And this time around, we're already picking up to where we had been before, and we could go still higher. So just kind of wrapping it up here, we look at everything we can on the macro outlook for inflation. This is the Dallas, Kansas, New York, Philly, Richmond Fed prices paid, prices received surveys, and you can see they look kind of toppy. They look like they stopped going up anyway, so that's somewhat encouraging news. The bad news is they're still right up there, quite high. So with that, let me thank you for listening to my January 3rd webinar on some of the thoughts we have starting the new year. I hope you have a great year, and hope you tune in again next week. Thank you so much.